What if I told you that where you bank is costing you hundreds, maybe thousands of dollars every year, and that most people are getting ripped off by institutions they trust with their life savings? Today, we're settling the credit union versus traditional bank debate once and for all. By the end of this episode, you'll know exactly where your money belongs and how to stop paying fees that are quietly draining your wealth. This is going to change how you think about banking forever. Hey everyone, and welcome back to Simple Finance Bytes, where we break down personal finance in plain English for people working toward financial independence and the simple finance way. I'm Ernest, and this is episode 2. If you missed our first episode about why simplifying your finances is the key to building wealth faster, definitely go back and listen to that. It sets the foundation for everything we're going to talk about today. Today, we're deep diving into one of the most important financial decisions you'll ever make: where you actually keep your money. And I'm going to be brutally honest about something the banking industry doesn't want you to know. Most of you are banking with institutions that see you as a profit center, not a person, and it's costing you real money. So grab whatever you're drinking, get comfortable, and let's talk about how to pick the right home for your hard-earned cash. Let's start with the uncomfortable truth. Traditional banks are not your friends. I know that sounds harsh, but hear me out. Traditional banks like Chase, Bank of America, Wells Fargo, they're publicly traded companies. Their primary obligation isn't to you. You're the customer. It's to their shareholders. They need to show quarterly profit growth. And guess who gets to pay for that growth? You do. Here's how they extract money from you: monthly maintenance fees. Many traditional banks charge you just to hold your own money. We're talking $12 to $25 a month for checking accounts. That's $144 to $300 a year just for the privilege of banking with them. Overdraft fees. These are the worst. Banks deliberately process your largest transaction first to maximize the chances you'll overdraft multiple times in one day. One mistake can cost you $35 per transaction, and they'll hit you with multiple fees on the same day. Minimum balance requirements. This is even worse in some ways. Fall below their arbitrary threshold. I've seen some as quote unquote low as $500 and some at $1,500 or $2,000. Fall below that arbitrary threshold and boom, you're paying fees. They're literally charging you for not having enough money. Think about how backwards that is. Someone doesn't have enough money to meet this arbitrary threshold, so then they charge them more money. To me, that's incredibly predatory. ATM fees. Use an out-of-network ATM, and you'll pay fees to both your bank and the ATM owner. That's $5 to $7 for accessing your own money. Low interest rates on your savings. Traditional banks pay you essentially nothing on your savings, often 0.01 to 0.05% annually. That's tiny. Meanwhile, they're lending your money out at 7, 15, even 25% interest rates. Here's a real example. Imagine you had $10,000 for your emergency fund in a traditional savings account at one of these big banks earning 0.01% interest. You'll make $1 in interest per year. $1. They're holding 10,000 of your dollars, lending them out, making money off of it, and you're getting $1. Meanwhile, inflation is eating away at your purchasing power. But here's what really gets me. They make it this complex on purpose. The more confusing their fee structures are, the more likely you are to accidentally trigger charges or put your money in a place where you get nothing back and they make all the profit. This is a feature, not a bug. Before we dive into the solution to all this, make sure you're getting all our latest content. Head over to simplefinancebytes.com and browse through our library of articles on banking, investing, debt elimination, and more. While you're there, sign up for our free monthly newsletter. It's where I share the best tips, recap all of our episodes, and give you exclusive content you won't find anywhere else. No spam, just value, I promise. You can unsubscribe at any time, and we respect any unsubscribe requests. So what's the alternative? Credit unions. And no, this isn't some nostalgic throwback to the 1950s. Credit unions are legitimately better for most people, and here's why. Credit unions are not for profit. They're owned by their members. That's you. When you sign up for a credit union, you become a member. That means you are part owner of that credit union. Similar to how a shareholder is with a bank, except that it's a nonprofit. So it's not a shareholder. You're a member. You have a portion of ownership of that credit union. Any profits they make get reinvested back into better services or returned to the members. They don't have shareholders demanding ever-increasing profits. Lower fees and often zero fees. Most credit unions offer free checking and savings accounts with no monthly maintenance fees, no minimum balance requirements, and much lower overdraft fees if they charge them at all. This is the key reason why you want to look at a credit union first, because they're not going to charge you to hold your own money. So if you ever end up in a situation where you don't have enough money sitting in the account because you ran a little thin that month, you're not going to have to pay a fee because of a minimum balance. A good, legitimate credit union should not charge fees for any of these basic things. Better interest rates. So credit unions typically pay higher interest rates on savings accounts and offer lower interest rates on loans. It's not unusual to find credit union savings accounts paying 10 to 50 times more than traditional banks. Again, traditional banks are at 0.01, 0.05, practically nothing. Credit unions are going to give you more than that. Two of the credit unions I use, one of them gives like 2.9% if I'm not mistaken, and the other one I want to say is 3.2%. That's not as good as, say, a high yield savings account, but that's a very respectable interest rate for a place where your money is absolutely safe, and it's a credit union, so your working within that credit union is benefiting both you and the community and the other members of the credit union. Credit unions are also well known for personal service. They're usually smaller and more community focused, so when you call, you're more likely to talk to a human being who actually wants to help solve your problem. The other thing that's really awesome about credit unions is shared branching and ATM networks. This is huge. Most credit unions participate in shared networks, which means you can bank at thousands of other credit unions nationwide and use tens of thousands of fee-free ATMs. That's called a co-op system. So there's a co-op ATM network, and then there's also a co-op shared branching network. The shared branch concept is incredibly cool, and I wish every credit union did it, but not all of them do. But if that does matter to you, make sure your credit union is both a shared branch co-op and an ATM co-op. Most of the time, when you have a credit union checking account and a debit card from a credit union, you can go to just about any other credit union in the country and use their ATMs fee-free because they're part of that co-op network. Now, not every single credit union is part of these co-op networks, so definitely do your research, but the vast majority are at least part of the ATM co-op network, and that matters. Now let me address the common objections. Credit unions have bad technology. Not anymore. Many credit unions have mobile apps and online banking that rival or exceed what the big banks offer. Plus, if you're following our advice in the Simple Finance Bytes system, you pair a local credit union with an online bank or fintech that has an excellent app and many services for your online and day-to-day transactions. You get the best of both worlds. Plus, you also get some isolation and some risk management when you do it that way. We'll talk more about that system later in the podcast and then in future episodes of the podcast. Objection number 2, credit unions are hard to join. Some do have membership requirements, but they're usually pretty easy to meet. You might need to live in a certain area, work for a particular employer, or make a small donation to a partner nonprofit. it's rarely a real barrier. Almost all of them are very easy to get into, with the exception of certain ones like Navy Federal, where you must be current or former military, family of military, Department of Defense, something like that. That probably has the highest barrier I've ever seen to entry to a credit union, but the vast majority of them are easy to get into, especially the ones that are only bound by where you live, because you can find one in your community. What if my credit union fails? Credit unions are insured by the NCUA, the National Credit Union Administration, just like banks are insured by the FDIC. Your money is just as safe in a credit union as it is in a bank. Here's my personal story about credit unions and banks. When I was very young, my mom took me to our local credit union and opened a custodial account with me. That's where money would go that people gave me for birthdays and other things like that. I knew of it as my bank, but I didn't understand what a credit union was. I rarely used the account, and when I started college, Bank of America was there handing out free accounts to all the new college students. Literally, just they had a little booth set up in the quad area, and they were signing all these college students up for free checking accounts. I didn't really understand the difference, but I knew that they were a big national brand and they had ATMs everywhere, so I signed up. Imagine my surprise when I started seeing random fees in my account after I graduated. This is about when I noticed that B of A was paying me peanuts compared to what my credit union money market savings account was paying. This was when I woke up. Not all credit unions are created equal. Here's how to find a good one. Number 1, look for zero fees. Your credit union should offer free checking and savings with no monthly maintenance fees, no minimum balance requirements. If they're charging you monthly fees, keep looking. Do not go to that credit union. That is like the number 1 red flag. Check their ATM network. Make sure they participate in a large shared ATM network like Co-op or Allpoint. You should have access to thousands, if not tens of thousands, of fee-free ATMs. Verify NCUA insurance. This should be displayed prominently on their website. If you can't find it, ask. No NCU insurance is a deal breaker. You can also go to the NCUA website and look them up there and verify that your credit union's on the list. If a credit union does not have NCUA insurance, do not use that credit union, just like you should never use a bank that does not have FDIC insurance. Test their technology. Download their mobile app and check out their website. You'll be using these regularly, so make sure they work well. The one caveat here is typically you cannot log into an app or an online banking session without having become a member first. So you want to do all the heavy research first, narrow your options down to maybe 2 or 3 credit unions, pick the one that you think will be best, open the account with them first, then do this. Test the technology, download the mobile app, check out the website. You can also probably find screenshots and videos of their interfaces on other places like on YouTube or on social media. Do the research ahead of time. The next thing is to consider their loan rates. Even if you don't need a loan now, check their rates for auto loans, mortgages, and personal loans. Compare them against the big banks and other credit unions in your area just to get an idea of where they sit in the range of loan rates. When you do need to borrow, you'll want competitive rates. And generally, that credit union is going to always be in that same range as far as the competition. So they may not have the best rates, they may not have the worst rates, but you have to balance everything out because an interest rate by itself doesn't make all the difference. It does make a difference, right? You don't want to be overpaying for your interest rates, but also you don't want to be doing business with a shady credit union or one that doesn't meet your other needs to save 0.1% on your interest rate on your loan. So consider the loan rates, but it's an entire package you're looking at here. Ask about membership requirements. Some credit unions have specific geographic areas, employers, or organizations. Others are open to anyone who makes a small donation to a partner charity. Find out what you need to do to join. It should be prominently listed on their website. If not, call their customer service line and ask. Any reputable credit union will be happy to share that information with you before you ever open an account with them. Here's a pro tip. Start with credit unions in your immediate area, then expand your search. Local credit unions often have the best rates and the most personal service. There may be many credit unions in your local area, so the easiest way to weed out the bad ones is to look at what fees they charge. If you see anything about account maintenance fees, account minimums, or overdraft fees that are just as high as the regular banks, say $30 to $35, that's a huge red flag and an easy way to disqualify that credit union from your list. The other thing, if it's possible, is to ask other people who may have a relationship with that credit union or have an account at that credit union if they happen to be a friend or a relative of yours. That is often the best way to get the information because it'll be unbiased. They'll tell you exactly what their experience is. For example, I work with 3 different credit unions personally, a local one here in the Bay Area of California, a local one back home in Texas, and then a national one, Navy Federal. I'm happy to give anybody a review of any of those 3 credit unions. All 3 are great at certain things, not so great at other things. No institution is perfect. It's not to say anything bad about any of these credit unions. I love all 3 of them, but nothing is perfect, and every credit union is tailored a little bit differently. For example, some credit unions are tailored more towards savers, so they'll give you much better rates on your savings accounts, and maybe their loan rates are not the best, and you're not getting too much in terms of cash back on their credit cards or something like that. Other ones are more transaction-based, meaning you'll get better perks and benefits on the checking account, especially if you use them a lot, but not too much on the savings account. Some of them are loan first, meaning you're not going to get too great of rates on your checking or your savings as far as the interest they're paying you, but your auto and mortgage loans are going to be at the lowest rates possible. So again, find a credit union that aligns with what you need and then work directly with that credit union. Speaking of finding the right financial institutions, we've got tons of resources to help you optimize your entire financial setup. Visit simplefinancebytes.com to check out all our articles on banking, credit unions, high-yield savings accounts, and more. And don't forget to sign up for the free monthly newsletter while you're there. It's the best way to stay updated on all of our latest tips and strategies. Okay, so here's what our banking strategy looks like. Here's the exact banking setup I recommend, and it's what I personally use. Step 1, choose a local credit union for your primary banking. This becomes your financial bunker where you keep your emergency fund and handle basic banking needs. Look for free checking and savings with good interest rates. Step 2, don't use your credit union for everything. Here's where most people mess up. Your credit union account should be kept offline as much as possible. Don't link it to a bunch of apps and online services. That's how things get compromised. Don't use the debit card for online purchases. Don't be sticking the debit card inside of pumps at gas stations. Matter of fact, don't be sticking a debit card inside of anything other than an ATM at the credit union physically attached to the building because the risk is much lower if there's a skimmer in there. This protects your main accounts from fraud and data breaches. So again, you're going to keep your primary source of money in the credit union, especially your emergency fund, in the high yield savings account or money market savings account, whatever they call it, and do not connect it to online services and shopping. Instead, what you're going to do is go to step 3. Pair your credit union with an online bank or fintech. I personally use Capital One Bank for this, but there are many out there. Discover Bank, which just got bought by Capital One, SoFi, or even PayPal offer excellent online banking with competitive interest rates and robust mobile apps. Every one of those has a good app. Discover's app is probably the least nice of them, but Capital One's app is great, SoFi's app is amazing, and PayPal's app is great too. Use this account for your online bill pay, subscription management, and any online transactions. You want to run everything through this online service, including connecting your P2P apps like PayPal, Cash App, Venmo. You do everything through the online bank. Why? Because this 2-account strategy creates a natural firewall, right? If your online account gets compromised or one of the P2P apps that you have connected to it gets compromised, your credit union and your emergency savings are completely protected. They're isolated, right? So it's safe. You get the best of both worlds. Local personal service from your credit union and cutting-edge technology and services from your online bank and P2P services. Step 4, and this is the most important step as far as I'm concerned and as far as we are concerned in this channel, which is keep it simple. That's why I named this Simple Finance Bytes, and why we're going to have a simple finance system coming out soon that helps you do all of this and even automate all of it if you really want to set it and forget it type thing. Keep it simple. 2 accounts max for your banking. Any more than that, and you're just creating complexity for no reason. Now, if you're a small business owner or have a side hustle, you definitely have a reason to have another bank account to keep your finances separate, because that's very, very important from a taxing perspective and from making sure your business is actually profitable type of thing. That's not what we're talking about here. This is just your personal finances. Keep it simple, 2 accounts max. Let me give you a real example of how this works. Your paycheck from work goes into your credit union account. You immediately transfer a set amount to your credit union savings for emergencies and goals. So this is basically your emergency fund, and if you have any sinking funds, that's going to be held in your credit union. Then you transfer your monthly spending to your online bank account. Some employers will even allow you to split your direct deposit between 2 or more financial institutions. So if you want to simplify this even more, you can do that and split between your credit union and online bank so that you don't have to manually transfer funds from one to the other every paycheck. You just set your direct deposit to put whatever you need as far as your regular bills and your emergency savings to your credit union, and your daily spending and whatnot goes into your online bank or fintech. You use your online account for all of your non-critical bills. So for example, you might have your rent or your mortgage being auto-deducted from your credit union checking account, but all of your subscriptions and whatnot are probably going either to a credit card or to directly to your online bank's debit card, whatever the case is, preferably through a layer like PayPal. But the point is, you're using your online account for all of your non-critical bills, subscriptions, and online purchases. Your credit union stays clean and protected. This is so important. I can't tell you how many people have been victims of bank fraud and other kinds of financial fraud because they were only using one institution and connecting everything into it. You have to look at it from the perspective of somebody like me who worked in information security for over 25 years. Every time you connect something to the internet, your risk of fraud and theft skyrockets. So you want to minimize that as much as possible. You're not going to be able to get it to zero, right? You're still going to need to access your credit union account either through a website or through an app on your phone, but don't connect it to other services that can also get hacked, right? Limit your exposure as much as possible. If someone steals your online banking information, the worst they can access is 1 month of your spending money. Your emergency fund, main savings, and your critical bills like your rent or your mortgage stay completely safe. Now, here are some common mistakes to avoid. Don't overthink this. Pick one good local credit union and one good online bank. Don't try to optimize across 5 different institutions. It's okay to make a mistake here. If you pick a credit union and then you discover 6 months, a year down the line that they're not the best credit union for you in your area, that's okay. If you found a better credit union, open an account over there, move all your stuff over, and close down the old one. Same thing for the online bank. If after a while a better option comes out, say for example you start out with Capital One, but then you get to the point where you want to start looking at some investing and some additional options that Capital One doesn't offer, but SoFi does, it's okay to open up a SoFi account. It costs you nothing. Open that account, start transitioning your stuff over there, and then either keep or close the Capital One account. It's up to you at that point. But don't overthink it. Pick one good local credit union, one good online bank, and just go. And then adjust as needed. Don't chase interest rates obsessively. The difference between 4.5% and 4.6% interest on your emergency fund is not going to make you rich. It's not going to matter long term. Focus on simplicity and security first. My relationship with Capital One Bank is a perfect example of this. I forget what their current interest rate is. It's either 3.6 or 3.8%. There are plenty of other high yield savings account paying 4%, 4.1%, 4.2%. But here's the thing. I don't want to go through the trouble of moving all of my stuff from one institution to another to gain 0.1, 0.2, even 0.5%. It's not worth the hassle. And Capital One is a good bank. They're FDIC insured. Every time I've interacted with their customer service, it's been an excellent experience. I like their app. All of that put together makes it a much better experience, and it's simpler. So I'm focusing on the simplicity and the security of my setup as opposed to trying to get 0.1% more on interest. It literally doesn't matter. Now, on the other side, one thing that does matter is fees. Don't ignore fees. A bank offering 5% interest doesn't help you if they're charging $15 a month in fees. They're literally draining you like a vampire and you're not even realizing it. So pay attention to fees. Fees matter. So here's your homework after this episode. First, audit your current banking situation. Add up every fee you've paid in the last 12 months. Monthly maintenance fees, overdraft fees, ATM fees, everything. I bet the number is higher than you think. The second step, research credit unions in your area. Use the Credit Union National Association website to find options near you. Look for the criteria we discussed: zero fees, good ATM networks, NCUA insurance. Third, this is important too. If you decide to switch, don't rush it. There's no hurry here. Open your new accounts first, test them out. Get into the online banking interface for the credit union, also onto the mobile app. Get a good feel for it. Are you okay with it? Once you're comfortable, then gradually move your direct deposits and automatic payments over to your new credit union. Fourth, once you're set up with a good credit union, consider adding the online bank for your day-to-day transactions. This isn't urgent. Get comfortable with your credit union first. Remember, the goal isn't perfection. The goal is progress. Every month you're not paying unnecessary banking fees is money that can go toward debt payoff, emergency savings, or investments. We will definitely talk a lot more about investments in future episodes of this podcast and on our website, and our ultra simple method to investing. Again, simple finance is what matters here. Simple finance is what wins at the end of the day. We're not here to confuse people. We want you to live a stress-free life. This stuff matters because it's foundational. If you're hemorrhaging money on banking fees, it doesn't matter how good your investment strategy is, you're starting from behind every single month. Want to dive deeper into optimizing your entire financial setup? Head over to simplefinancebytes.com where you'll find detailed articles on everything we've discussed today, plus guides on credit cards, investing, debt elimination, and more. And seriously, sign up for our free monthly newsletter. Number one, it's free, it's valuable, and it's the best way to make sure you don't miss any of our money-saving tips and strategies. Thanks for hanging out with me today on Simple Finance Bytes. If this episode opened your eyes to how much your current bank might be costing you, you're not alone. I hear from people all the time who discover they've been paying hundreds of dollars per year in unnecessary fees. Let's just call them junk fees because that's what they are. The good news is now you know better and you can do better. Here's what I want you to do right now. First, if this episode was helpful, share it with someone you care about. Most people have no idea how much their banking choices are costing them. Second, make sure you're subscribed to the podcast so you don't miss future episodes. We're going to keep building on these foundational topics over time. Third, visit simplefinancebytes.com, explore our resources, and sign up for that free monthly newsletter. That's where I share the best content and where you'll hear about new episodes first. Next week, we're diving into debt elimination, specifically why the debt snowball method works better than the math says it should. If you're carrying any consumer debt, it's credit cards, personal loans, buy now, pay later, whatever, you don't want to miss next week's episode. Until then, keep it simple, stay focused, and take control of your financial future.